Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill, your host. This is episode 12. In a few moments, I will interview Carl Torrillo of Ace Portal, which is an online investment platform. But first, what's in the news? Well, CVS, the familiar, because it has 8,000 outlets, pharmacy chain, made news about a year ago when it stopped selling tobacco products. Of course, there was an irony there that it had been selling tobacco products all along, getting you coming and going, one might think. Or maybe we shouldn't be so hasty with regard to tobacco. Erica Fry, in the September 22nd edition of Fortune magazine, wrote in her article entitled How to Stop Ebola that a drug used to treat American medical missionaries who had contracted Ebola was grown in tobacco plants, and furthermore grown in facilities owned by R.J. Reynolds Tobacco. As Fry notes in her article, manufacturing drugs in growing plants, sometimes called farming with a PH, is not a new technology. In 2009, the Defense Advanced Research Projects Agency challenged 3 tobacco farming facilities to produce 10 million doses of flu vaccine in 1 month, and they did. So if you're brainstorming new ideas for where to allocate some of your investment dollars, pharma may be worth looking at. Of course, if the investments pan out, you have my permission to call it fat farming with PHs all around. Moving right along, if you are thinking of becoming Johnny Angel and making an angel investment in a startup, one of the many data points you should consider is this: how hard is the founder working? Now, that data point is something that the sharks on the television program Shark Tank regularly inquire about. And as noted on an earlier Accredited Investor Markets Radio broadcast, Shark Tank isn't exactly a faithful representation of angel investing. It's an entertainment program, but I digress. How hard the founder works is the focus of the Schumpeter column in September 20th's Economist magazine. Based upon the anecdotal evidence presented in that article, if the founder of your potential investment is not sleeping on a mattress in his or her office and is not living off instant noodles, you may want to think twice. Of course, our tongue is firmly planted in our cheek when we say that. Neither we, nor the economist really, advocate the idea that a founder needs to suffer to such a degree in order to make a startup work. One notes, though, that a grueling experience like that might actually be detrimental to success. Nevertheless, making sure that a founder is working at a level with which you are comfortable, that you think is appropriate, may be something that it makes good sense to do. All right, going from less intense to more intense journalism, I'd like to tell you about an article in an online publication called The Middle Market. So it would be at themiddlemarket.com, dated September 22nd, by Danielle Fugazi, entitled Manufacturing Deals Reassemble 5 Significant Sectors. And here's a quotation from the article. The quotation is by a man named Zia Uden, who's a managing director with Monroe Capital, LLC. Mr. Uden says there's a lot of growth in the manufacturing industry. Insourcing or reshoring has been playing a role for quite some time. There is a greater desire to develop products and get them to local markets more quickly, which is making manufacturers all the more important. He's speaking about U.S. manufacturing. Many of us have heard the lament that we don't make anything anymore. Well, that lament has never been true. It's true that some things, like shoes and textiles, are now made outside of the United States principally. It's true that manufacturing employment has plummeted, but that fall in employment levels in manufacturing is a function of efficiency through capital investment and technological process, which is making each individual worker much more efficient. The volume and value of U.S. manufacturing has grown without stop since 1970, with the exception of the recession years of 2001, 2008, and 2009. So the article, Manufacturing Deals Reassemble 5 Significant Sectors, is really about growth and opportunity. And it examines in great detail, useful detail, the following 5 sectors: aerospace, electrical equipment, food and beverage, healthcare, and packaging. Well, with that way to wisdom having been set forth by me, let's move forward with our interview today. We have with us today Carl Torrillo, Chief Financial Officer of ACE Portal, or ACE Portal, which, in association with the New York Stock Exchange, provides a technology platform for new issuances of private securities. Well, Carl, let's get right into it. How has Title II, the lifting of the ban on general solicitation, affected the industry?
Well, Chris, first of all, thanks very much for having me on. Very excited to share some thoughts about the private markets and about ACE Portal in general, and that's a great first place to start. Title II has started to affect the way private securities are being marketed, and we're seeing that on a daily basis here at ACE Portal. In fact, since March, roughly a quarter of the deals that we've seen posted to our platform, and so that's about 9 out of 35, have listed in accordance with what's known as 506C under the Jobs Act, and that allows the issuer and their placement agents to avail themselves of general solicitation. I find that actually very interesting in that I had not expected larger scale offerings to really go the route of general solicitation until this was a little bit more fleshed out in the marketplace. So what we've practically seen is companies and their placement agents, and here at ACE we work exclusively with the placement agents, so we've seen them operate controlled processes where they're reaching out to a broader network of investors than they would ordinarily reach out to, but they're doing it in a controlled fashion using technology to basically reach out to the vast market of accredited investors in the marketplace.
So 506C offerings are coming faster than, or coming in larger increments or larger forms than you expected?
I wouldn't say in the larger forms. Actually, it's interesting. I mean, all of our transactions are institutional, but I would say that they skew to the smaller scale still. So while they're institutional deals, and I've actually, got a couple of figures here that I can share, of the deals that we've looked at or that are currently being placed on the ACE portal, the average size of a regular way, kind of old school 506B transactions around $40 million, whereas the average size of a 506C transaction is more on the order of $25 million. So we're seeing them creeping into the institutional market, albeit still kind of at the smaller end of the institutional scale transactions.
Well, smaller, but not that much smaller. I'm impressed actually by how close they are to one another. Which brings me to my next question. There's a quote of yours that I very much like. You have said that you are inspired by the idea of, quote, democratizing access to capital for deserving companies, and in turn, democratizing access to deal flow for investors, end quote. And you've also said you believe this would help stimulate growth in the economy. Can you explain the quote?
Absolutely. And so to step back a little bit, by way of background, I started my career in investment banking. I spent over a decade raising capital for large-scale institutions, primarily industrial kind of blue-chip companies. And it's remarkably easy for large-scale companies to raise capital. But what I found incredible from my practical experience was that it is very difficult for companies that I would say in the so-called Death Valley, meaning between post-VC stage but pre-IPO stage, it's very difficult for those companies to be funded. And that's a result of some of the regulatory environment. A lot of the rules and regulations that address securities transactions were written over 80 years ago and don't really contemplate the evolutions in technology that we've seen. And so for me, the Jobs Act was really very much a watershed moment in terms of changing the perception of those rules that were written so long ago and opening up an opportunity for technology to facilitate these types of transactions. And so I'm a firm believer in sort of free markets providing the most efficient solution to capital formation. And so in that regard, when I think about democratizing access for deserving companies, I believe having those companies able to reach out to a much broader pool of potential investors will result in the right companies being funded. And again, since there's no centralized infrastructure for investors to really currently seek out deals that are of interest to them in the private market, it also serves to democratize access for investors to go seek out interesting companies that they want to back. And those companies, once they're funded, those really provide the growth engine for job growth in this country.
Am I hearing you correctly, or am I imposing my own meaning on you when I say that it sounds like it isn't simply a matter of a broader pool, but of a greater range? That is, more capital is available to more companies, potentially or really at this point, at more stages in the development of a company.
I would agree with that. And I say that because if you look at the companies that traditional investment banks are capable of covering, they tended to skew towards the larger scale. As technology can be applied to more easily facilitate transactions that banks and placement agents are currently marketing, they'll be able to go one step further down into the scope of companies that they would traditionally help raise capital for, and they'll be able to take on the incremental deal, the deal that they may have passed on because they thought perhaps it wouldn't get done. Further, and this is outside of the scope of what we do at ACE Portal, but also importantly, the Jobs Act created other means for companies to raise money earlier in their life cycle, and so that, that starts to get into the crowdfunding side, which, is outside of the purview of what we do, but which I do think is important in terms of fueling the overall growth in the economy.
Well, let's get back to what it is you do, and then we'll move on to other platforms and so on, or the platform industry, we might call it. ACE Portal is in association with the New York Stock Exchange. What does that mean, and what's the meaning of that for accredited investors?
Absolutely. So ACE received an investment and has a strategic relationship with the New York Stock Exchange that was announced roughly a year ago, September of 2013. And what it means for us, as I think about it, the New York Stock Exchange really brought a unique perspective and a unique model in terms of adding transparency to the public markets. And that dovetails very nicely with the goal at ACE of bringing greater efficiency and transparency into the private market. And so I think the value proposition is pretty clear to accredited investors in that regard. We're aiming to have access, or to deliver access, to a very transparent and independent landscape of transactions. And that growing pool of opportunities across many, many placement agents should help them understand and compare the types of opportunities that are out there versus having to cultivate individual relationships with each placement agent marketing these types of transactions, and then not really having a centralized infrastructure to compare terms and to compare value of those types of deals.
That all sounds great because, after all, for an individual accredited investor to do those sorts of things on his own, well, that person would probably have a job in your industry. So what diligence does ACE Portal do on a company or fund before it allows it to list on ACE Portal? Are there certain minimum objective metrics, for example, that a placement agent must have before ACE Portal will list it?
We really focus our diligence efforts on the placement agents that are joining the platform. We conduct a background check on them. We get to know them. We have pretty extensive relationships in the industry, so we're able to do confirmatory diligence by checking with parties who've worked with the agents in the past. And that provides the primary screen in terms of the deals that are listed on ACE Portal. We try to stay away from evaluating transactions on a transaction-by-transaction basis. First of all, we're not a broker-dealer ourselves, so it's not really our place to evaluate those transactions specifically. That said, we will review the placement materials to make sure that there are no red flags raised, so we do apply a bit of our expertise from our years in investment banking to make sure there's nothing untoward in the offering materials. But outside of that, it's really on each of the placement agents to vet the deals that they end up listing on the platform themselves. And our view is that each agent has their own reputational concerns to manage, and so we're relying on their reputational concerns and making sure that they're putting good product out as we are willing to work with them. And that's important because we very much believe our reputation is critical at this point. This is a new and emerging market, and so we have to make sure we get everything right out of the gates.
So in short, it's people, not transactional metrics that explain a significant amount of your due diligence.
Yes, I mean, I would say we do have certain deal minimums. We hold to a $5 million minimum, and frankly, most of our deals have skewed higher than that. And aside from that, we have a minimum fee requirement that's upfront, and that helps to kind of organically curate the market as you think about, would an agent be willing to pay for a deal up front if it's not of the quality that they think that they can actually end up closing the transaction?
Well, here's a chance to talk a little bit more about ACE by talking in general terms at least about the competition or perhaps the non-competition. There are other private investment platforms. There seems to be a large array of them. I don't know, maybe you can tell me how many there might be that have cropped up to serve the demand from 506C exemptions to the securities regulations. So what distinguishes a platform from another? What distinguishes ACE Portal from other private investment platforms aimed at accredited investors?
Absolutely. You know, it's a tough question to answer, the first part. It's hard to say how many portals have sprung up since the Jobs Act passed and since Title II went into effect last year, and with Title III still kind of on the come. There's a lot of activity, which I think is great because it's brought a light to this market, and it's becoming a little bit more regular way now for people to contemplate using a portal to supplement their demand on the investor side, for issuers or placement agents to supplement their demand. I'd say that what differentiates us, there are a number of things that differentiate us. I think probably the most important thing is the fact that we're working with broker-dealers on all of our transactions, and so we're really trying to become an independent backbone for the marketplace in general. I think a lot of our competitors are approaching the market and seeking to disintermediate the incumbents in the space, whereas we're attempting to be a little bit more evolutionary, keeping the existing system in place, keeping the existing checks in place in terms of the diligence and the work that's done to evaluate the different issuers who ultimately are raising capital. That work is done by those broker-dealers, and then we're opening up that whole market of broker-dealers to accredited investors. So we really want to be the one-stop shop for investors to come in. We don't have a vested interest in any one deal closing on our platform. So again, the independence factor is really what I think sets us apart. We're not individually vested in any one transaction, and we're really trying to provide a forum for investors to come in. And one other thing I should say is that confidentiality is very important to us. We recognize that accredited investors don't want their information shared until they're willing to share that information, and so we respect that privacy. We allow investors to come in, review transactions up to teasers, and it's interesting, we talked a little bit before about general solicitation, and this is one of the ways where issuers and placement agents who avail themselves of general solicitation, the amount of information that can be shared prior to an investor giving their information to a placement agent differs. Obviously, under 506C, if a company is availing themselves of general solicitation, a lot more information can be shared. So that, you know, that's helpful in terms of this this evolution in the market and this ability to more successfully raise funds. The more information you can share earlier on in the process, the better off you're going to be. And that's been sort of borne out in the data that we see in terms of the number of investor looks that individual transactions get.
All right. Well, how does ACE Portal then generate returns for itself?
ACE is strictly charging a transaction-based fee up front to the placement agent who's listing the deals right now. So there's no fees for accredited investors, and we don't ever anticipate charging our investor base for access to the transactions.
Well, okay. Now, let's say an accredited investor is of a more traditional mindset and does not want to deal with portals, such as ACE Portal or others. How is that accredited investor's investment experience going to differ from the experience of somebody who deals with portals now that Title II is upon us?
Well, I think first and foremost, their access to transactions is going to be somewhat more limited. They're going to have to rely on their traditional relationships with the types of intermediaries who market these transactions. So they're not going to have access to a centralized infrastructure to proactively seek out transactions that are of interest to them. And this is the way practically, sort of in my experience going back to being a banker, you'd talk to some of these investors, you'd make notes in your CRM system about what types of deals they want to see, and then you would go back to those notes when you found a relevant transaction. The issue is, unless you're a very large-scale investor, you're probably not going to be on that short call list that the investment bank is executing against. Going back all the way to what we were talking about at the beginning about democratizing access, that's what it's really about for me, because typically those deals reached 50 to 100 investors the manual way, with a couple of guys on the telephone picking up and talking to investors about a potential private placement. Here, there's a much more efficient infrastructure available to reach out to the 40,000 plus qualified institutional buyers and over 8.5 million accredited investors that are in the marketplace, and that shouldn't be cut off from seeing these types of transactions.
Okay, so it's more democratized, although it does place at least a little burden on the AI, the accredited investor, in that the accredited investor must not trust 4 or 5 people to give him or her tips, but would be well advised to open himself or herself to one or more platforms and to root around in the platforms for different opportunities.
Absolutely. I mean, you hit the nail on the head. It's also about seeing the other transactions that are out there at the same time as the one that you're evaluating, so you have a reference point. We call that comparable benchmarking, and I think that's incredibly important for investors to be able to handle. One of the things we're also working on right now, because look, it can be very challenging for an accredited investor to evaluate these types of transactions, especially since if you do end up investing, you could end up with a very long hold period because there's not a liquid market for the secondary interest in that particular issuance. So when we think about it, we've been working with a number of diligence providers, institutional quality diligence providers, that we're going to vet over time, and we'll make them available to the investors who are looking at specific transactions on the ACE portal, and we'll allow them to kind of aggregate into a pool and, if they would like, purchase institutional quality diligence before investing in a security. And so, that's one way that portals can actually be additive in terms of the services that can be provided around the actual transaction.
Well, wonderful. I want to thank you, Carl, for engaging in this discussion of democracy and accredited investment.
Thank you very much for having me. It's been a pleasure.
Now, this was Carl Torrillo, Chief Financial Officer of ACE Portal, which in association with the New York Stock Exchange provides a technology platform for new issuances of private securities. I am Christopher Cahill for Accredited Investor Markets Radio. Thank you for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.aimkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.aimkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.